U.S. exceptionalism. The idea that America's economy and markets stand above the rest just hit a wall. A record number of global fund managers are pulling back from U.S. stocks, and now many say gold may be the asset to watch. Economic uncertainty means you have to keep up with what's happening. Make sure you subscribe, and we'll keep you in the know. According to the March Fund Manager Survey by Bank of America, allocations to U.S. stocks fell off a cliff, plunging 40 percentage points to a net 23% underweight. That's the biggest single-month drop on record. Michael Hartnett, the bank's chief investment strategist, didn't mince words. Peak U.S. exceptionalism is reflected in record rotation out of U.S. stocks. This isn't just about one asset class falling out of favor. It's about a deeper shift in belief. Nearly 70% of surveyed fund managers said they now believe U.S. exceptionalism has peaked, at least for the time being. Where is the money going? Interestingly, some of it is heading toward Eurozone stocks, which now sit at a net 39% overweight, the highest level since mid-2021. But more broadly, the trend is turning against equities altogether. Global equity exposure dropped from 35% overweight in February to just 6% this month, the steepest decline since July 2022. Instead, fund managers are moving into cash. Cash holdings jumped from 3.5% to 4.1%, the largest monthly increase in 5 years. And that may just be the beginning. Listen, what has happened has happened. The problem is what is going to happen, and the picture isn't pretty. According to the survey, 63% of global fund managers expect a weaker U.S. economy in the next 12 months, and 71% expect the dreaded mix of falling growth and rising inflation, stagflation. So where do you turn when stocks feel too risky, bonds feel unstable, and cash loses value over time? You turn to something timeless. In the same survey, 58% of fund managers said gold would be the best performing asset if a trade war erupts, and they're already positioning accordingly. Barron's echoed the sentiment, noting, "Gold has been one of the biggest winners during the stock market sell-off. That shouldn't change as long as uncertainty reigns." One top strategist agrees, and she just raised her target price. Solita Marcelli, Chief Investment Officer at UBS Global Wealth Management, now sees gold hitting $3,200 in the near term, up from her previous $3,000 forecast. Her reason? Gold remains a key portfolio hedge against near-term uncertainty, but also against episodic bouts of risk aversion further out. She's not alone. Some experts say gold isn't just reacting, it's still undervalued. Nicholas Colas, co-founder of Data Trek Research, says the S&P 500 to gold ratio implies a higher price for gold. Today, that ratio sits at 1.9, meaning it takes 1.9 ounces of gold to equal the index, but the long-term average is closer to 1.6. If that ratio reverts to the mean, gold could rise to around $3,550 per ounce. Colas adds, this isn't just math, it's macro. Gold can outperform stocks over the next year because incremental demand from non-U.S. central banks will continue to be strong, and other buyers will see the yellow metal as a hedge against geopolitical uncertainty. This is what happens when confidence fades and clarity takes its place. For investors paying attention, that clarity is priceless. At Augusta Precious Metals, we have been preparing our clients for this very shift with real education and unmatched insights. Because in times like these, you don't need more noise. You need a guide who sees the turning points before they turn into headlines.